So thanks for putting the paper on the program. This is joint work with my colleagues in New York, Thomas Eisenbach, Pooja Gupta, Orsha Har, and Peter Van Tasso, and the views are ours and not the views of the Federal Reserve Bank of New York or the Federal Reserve System. So if you follow arbitrage trades at all, you may have noticed in the last few years that a few of these have blown out. So here's a headline from 3 years ago at this point about the bond CDS basis not working anymore. And so what we're going to do in this paper is actually think about a cross-section of these trades and actually try to understand why these trades may not be working. So to understand what we are looking at, if you think back to a standard definition of arbitrage in textbooks, so arbitrage is supposed to be the simultaneous purchase and sale of the same or essentially the same security in two different markets for advantageously differential prices. Of course, when we talk about arbitrage in the textbook, we're usually thinking about the definition of arbitrage that doesn't require any capital to put on the trade, entails no risk, entails no funding costs, et cetera, et cetera. Now, we've known for a while that, of course, if you do actually have some of these components, so if you either have a financing cost or if you have risks to how long the two prices will take to converge back, you're going to have limits to arbitrage, and that may prevent some market participants from actually participating in these trades. So what are we looking at in this paper? We're going to look at arbitrage in a number of markets. So we're going to look at things like covered interest rate parity, treasury swap spread, CDS bond basis. And one thing that is very prevalent in all of these markets after the crisis is that we have large and persistent spreads in all of these markets. Now, what we're going to argue is that post-crisis regulations have increased the cost of participating in all of these trades for regulated institutions. I'm not going to go through all of the regulations in this table, but what I want you to get out of this is that if you think about some very standard trades, there are a lot of post-crisis regulations that affect both the cash market part of it, the derivative market part of it, as well as the funding costs. And so in this paper, we focus on the potential impact of the supplementary leverage ratio, or SLR, on the average level of all of these bases. Now, you may wonder why we are talking about regulated institutions when in a lot of these trades, you can think that unregulated institutions such as hedge funds can also participate in. The issue is going to be that unregulated institutions rely on regulated institutions for provision of leverage. So for example, if you think about a hedge fund buying, let's say, a treasury security, they would fund that through a repo transaction with a broker-dealer with a regulated broker-dealer who would then go ahead and rehypothecate that collateral back to a money market fund. And similarly, if you think about a broker-dealer as having a hedge fund client that wants to go long and a different hedge fund client that wants to go short, the broker-dealer is fundamentally going to be in the middle of both sides of these trades. And so they're going to take the long position from one of their clients and use that to create a short position for their other client. So to the extent that post-crisis regulations affect how much leverage regulated institutions, and in particular regulated prime brokers, can take, that can also be passed through to their clients. Here in particular, we're going to look at hedge funds. So what are some of the things that we find? First, we find evidence of impact of regulations on regulated institutions. So for example, if you take the US globally systemically important banks, which are usually characterized as having the greatest regulatory burden, they have lowered their repo and derivative activities since, roughly speaking, 2014. Where, again, we look at the return on equity for a bunch of basis trades. In the paper, we provide detailed descriptions of how these trades actually work and how regulations affect the different components of the trade. And what we find is that the return on equity is lower under a supplementary leverage ratio than under risk-weighted assets. And in particular, if you're thinking about banks having something like a 10 to 15% ROE target, which is what a lot of banks actually state in their disclosures as their return targets, you will see that the ROE under the supplementary leverage ratio tends to be well below that target. And in fact, the change in ROE is going to be biggest for trades that have the biggest change in capital costs if you move from risk-weighted assets to the supplementary leverage ratio. Finally, we have indirect evidence of the impact on unregulated institutions. So in particular, if you look at hedge funds that use leverage and get that leverage from prime brokers associated with globally systemically important banks, you will see that both their AUM and their returns have declined in the recent period. Okay, so really quickly, what do we know about aggregate bank behavior? So first, if you look at, for example, bank participation in repo markets, you have that since 2014, which is this rule implementation period, all banks have reduced how much repo activity they do, but in particular US G-SIBs, which again, think of them as being the most constrained institutions in the sample, and then US stress test institutions, excluding the US G-SIBs, which is the next most constrained group in the sample, have also reduced differentially more, but not as much as US G-SIBs. I'm not going to show you this, but if you actually look at detailed data on the securities financing exposure, and you look at what are the counterparties which are affected by these reductions, or what are the collateral types that are affected by these reductions, you see that the biggest reductions are happening in transactions with non-bank, non-CCP customers. Again, think hedge funds. And for transactions where you expect to earn a lower return, so transactions collateralized by super safe securities like cash, treasuries, etc. Yeah, so this is a reporting issue. So this is Y9C data, and in 2010 you have extra institutions being required to. Sorry, FBOs are foreign banking organizations. Yes, yes. So the investment banks here are just Morgan Stanley and Goldman Sachs. I mean, now they're bank holding companies, but and there is also a second bump here that's being driven by more foreign banking organizations being required to file this form as well. Okay, at the same time, if we look at over-the-counter derivative markets, again, in the full sample, we have a positive relationship between the overall gross notional being traded in these markets and how much gross notional is being traded between dealers. And importantly, this relationship for interest rate related securities and foreign exchange related securities becomes even stronger, again, post 2014. So what this says is that if you actually have decreases in how much activity dealers are willing to do with each other, you're also going to have decreases in the overall OTC derivative activity, which is not something that you see in exchange-traded derivatives, which are less reliant on dealers. Okay, so what does this have to do with basis trades? Well, let's think through a very standard basis trade, which is a treasury swap basis, and let's think that we're in a situation where this basis is actually negative. So how would you trade on that? Well, first you would go long a 10-year treasury, increasing your treasury position. You would fund that through repo with a haircut, which is why the increase in the repo position is less than 10 million. You would enter into a pay fix swap, posting the initial margin on that position. And finally, you would fund the swap margin and the repo haircut in unsecured markets, or of course, if you actually have cash available to do this, you could post your own cash. And so when we're talking about the full arbitrage spread, we're going to have a component that's just the basis, so the difference between the constant maturity swap rate and the constant maturity treasury. You have a funding cost, so the floating leg of the swap and the repo interest rate. And finally, you have the haircut and the margin funding cost. Here, really quickly, is the swap spreads for treasury interest rate swap trades. You can also look at a lot of other markets. Again, what you see is that after the crisis, all of these markets look unusual. And so if we're thinking about the return on equity for these trades, they're going to be determined by three things. One is going to be, of course, the level of the arbitrage spread, meaning how much money per dollar of trade you can actually earn. One is going to be the leverage requirement. So where here, leverage requirement is going to be tier 1 capital over some measure of assets. And then you're going to have a capital impact. And the capital impact is going to be determined by how much of the repo notional you're recognizing, how much of the derivative notional you're recognizing, what is the repo haircut, and what is the derivative margin, although the last two tend to be small relative to the first two components. So going back to the treasury swap trade, so let's take a particular day, November 11th, 2016. The basis was, or rather the arbitrage spread was around negative 85 basis points. If you wanted to do a risk constraint, so something like a value at risk, your implied ROE on this trade was 64%. If instead you did this with risk-weighted assets, so your leverage requirement would be 3%. You have the swap margin to recognize, the repo haircut to recognize. You recognize half of the 1.5% future exposure of interest rate swaps. And importantly, under risk-weighted assets, since this is a repo backed by US Treasury, you don't have to recognize any of the notional. Instead, if you do it under SLR, I mean, yes, you have a slightly bigger leverage requirement, but the biggest difference is going to be the fact that under a supplementary leverage ratio, you have to recognize the full notional of the repo. And so that's going to bring down the implied ROE of this trade from something like 370% under RWA to something like 13% under SLR. You can do this for a bunch of different trades. The left panel is showing you the average ROE if you were doing the calculation with risk-weighted assets. The right-hand side is showing you the average ROE if you're doing the calculation under the supplementary leverage ratio. And the basic point is that not only are the levels much higher here, but the levels here are all above the 10 to 15% target. Levels here are much lower and tend to be below the 10 to 15% ROE target. If you look at what is the change pre versus post 2014 in the basis, so you have greater increases in the basis for trades that have biggest changes in the capital impact. At the same time, you have bigger decreases in ROE for trades that have the biggest capital impact, suggesting that even though the level of the basis has increased after the crisis, it's not sufficient to actually offset the increases in capital cost. Okay, so why don't unregulated institutions step in? Well, the same regulations that affect the willingness of regulated institutions to enter into the trades on their own behalf also affect their willingness to provide credit or to provide leverage to their customers. If anybody is interested, we can go into the details of exactly how that happens. But essentially, the supplementary leverage ratio makes it much harder to provide leverage to your clients because you have to recognize that leverage as well. It's more difficult to net positions, et cetera, et cetera. So what you expect to see is that you have shorter maturities and higher rates for financing, decreased extension of credit, customer-specific analysis of balance sheet impact, and there is a lot of anecdotal industry evidence that actually lines up with these facts, with these suggested effects. In the paper, we look at hedge funds in the Libertas dataset, and we're going to be comparing hedge funds that use GC prime brokers and that use leverage to either hedge funds that use leverage but from a non-GC prime broker, or to hedge funds that have a GC prime broker but don't use leverage. One thing that I want to be upfront about is that we are right now using the one-time snapshots, although we're working on fixing that issue. So here are the results for comparing hedge funds that use GC prime brokers that either have or don't have leverage. And what you see is that you have, after 2014, you have lower gross AUM for the funds that use leverage. You have lower per fund AUM, lower number of funds using leverage, and also the same funds are going to have lower value-weighted returns. So I'm going to conclude. What we find in this paper is that post-crisis regulations affect the profitability of trading against arbitrage opportunities because they represent lower ROE for regulated institutions due to higher balance sheet impact. The same reasons are also going to prevent prime brokers from extending leverage to hedge fund clients, and we do find indirect evidence of that. You may have heard that in spring of 2018, there were some changes made to the Dodd-Frank Act and some proposed changes to the Volcker rule. Based on the analysis in our paper, we don't think that those are going to have a huge impact on basis trades because those are not the regulations that affect basis trades the more now. And finally, I want to emphasize that the results in our paper don't say that regulation is bad, because what we've been looking at are the cost of these, the potential cost of these regulations in terms of higher arbitrage spreads and potentially decreased market efficiency. If you want to do a welfare analysis, you also have to think carefully about the potential benefits of these regulations in terms of the resiliency of the financial sector during a crisis.